Hello and welcome to one of several special episodes of Market Minutes from Merion Global Investors, looking at the impact of the coronavirus epidemic on global markets and economy. Here to give us their impression on the outlook from here on in and on the impact of the virus on the market, I'm joined by Richard Buxton, Head of UK Equities, and Dan Nickols, Head of UK Mid and Small Cap. Richard, turning to you first of all for the view from 30,000 feet. What would you say are your high-level observations after what's been a pretty challenging few weeks?
Clearly challenging few weeks. Markets down 30%, some stocks down 50%, and in a very short space of time. Really from February the 22nd, 3rd, when the spread into Italy really convinced investors that this was not a Chinese-only issue, it's now gone global. Equally, the move by Saudi last weekend, I think, was very instrumental in this, because the perception of then this becoming a credit event, US shale companies, I think it's 14% of the high yield index is oil related, so people's concerns now. And clearly the fact that there is now going to be a recession, a downturn, which again reinforces concerns about balance sheets, leverage, so on and so forth. But unlike other such crises, we know this is a temporary phenomenon, painful and horrible though it's going to be. It will be V-shaped, because provided there is sufficient policy response, as we've seen in China, the moment that cases peak, then actually that marks the low of equity markets and people can begin to look forward to better times ahead.
So you're staying pretty optimistic about the prospects for a relatively quick bounce?
Absolutely. I think it is going to be painful, but a lot of pain has occurred in share prices already. And once we get a sense that central banks are ahead of the curve in terms of their policy response, then I think people can look across the valley and say, well, look, by the second half of the year, things will be picking up. Household balance sheets are in good shape, unlike in the financial crisis. This is about government debt is not an issue with bond yields where they are. Corporate debt, I say, is a concern. But if the policymakers can reassure on that front, then I think that'll mark a low point.
Yeah, before we drill down into some of those policy issues and indeed the sort of sectoral considerations, I just wanted to get your thoughts, both of you, perhaps Dan, you first, on the extent to which the fiscal and monetary policy responses we've seen this week will be effective.
Well, look, I think due credit to the UK authorities on this occasion, because I think, in a global sense, they've probably been the most proactive about doing things in a coordinated fashion. So you've had the Bank of England, I think, genuinely doing meaningful things in terms of putting in places the mechanisms to transmit cash into the real economy, in the areas in which it's needed. You've had, the new Chancellor actually taking a range of measures to make life that bit easier for business and small business in particular. So I think these things really are helpful. And again, they'll probably come into their own. They should cushion the economy against the worst effects of what's to come. But equally, as and when we come into that recovery stage, the measures should serve to, accelerate the nature of the recovery that we have as well. So I think, as I say, they've done really well, I think, in doing what they've done as quickly as they've done it and in a joined-up fashion.
Obviously, you're both very much fundamental investors. You spend a huge amount of time meeting, speaking with companies. In practical terms, has there been any impact from the unfolding virus crisis?
Absolutely. Most company meetings have now changed into conference calls and video conference calls, and indeed with clients as well. So that's going to be just part and parcel of something we've got to live with over the course of the coming weeks. As I say, drilling down into individual stocks and companies, unsurprisingly, since there's a concern about credit, the market has focused on companies with more leverage relative to less leverage. They have fallen the most, and those immediately impacted in terms of hotels, travel, airlines, and so on and so forth. I have exposure to some of those stocks, Very quickly, it's important to reassure that we do not think that there are balance sheet issues for these companies. IAG has one of the strongest balance sheets of airlines anywhere. And ironically, of course, as Flybe had already gone bust, others will fall by the wayside. And with a much lower oil price, the strong will get stronger into the recovery.
So less competitive pressure and cheaper input.
Cheaper input, yes. So, we mind our time as to when we're going to add to these stocks. I bought a little bit more IAG this week. SSP Group, airport hotels, again, airport catering, it's clearly going to be very badly affected. But again, on our stress test, there are moments in a doomsday scenario where it could be up against covenants. But I mean, this is a phenomenally secure business on any longer term basis. And, were they to need, relaxation, it's precisely those sorts of measures that the Bank of England, in its responses, has tried to ensure that banks will help such companies, through a temporary phenomenon. So
the obvious other two sectors that people will be focusing on, of course, the oil companies and financials.
Yes. Well, on big oil, I mean, we had already been having the debate post last year's clear de-rating of these stocks on sort of carbon-related ESG criteria. The degree to which it was ever going to be possible for current levels of dividends to be sustained whilst they're continuing to maintain existing oil production and make all those investments they're promising to into renewables. My personal view is that you should always take Saudi seriously. I think they are setting in for the long haul here. I think Russia is too, because they too have big shale facilities that I think they feel they can get out the ground pretty cheaply. So I'm not an optimist for the oil price bouncing back anytime soon. But I think, we've been debating on the desk, if the oil majors did actually halve their dividends, would they rally on the back of that? A sustainable 5% yield rather than an unsustainable 10%. In most instances, you find that a stock would actually rally. So we've not done anything on the oil positioning as yet. I think it's kind of worked through the numbers on this. Financials, again, the life assurers, it's a concern about their credit portfolios. The market always shoots first and asks questions later. And again, if companies have, as they've told us, really monitored the quality of their credit books well, then actually this could be an opportunity where they will rally very sharply once people feel that credit spreads have peaked and that there isn't actually a raft of bad debts. Banks equally concerns about impact of this slowdown, sharp on credit. Again, I think there will be opportunities for a rally. The question more on a longer term basis is if we are now facing negligible interest rates and a very, very flat yield curve for a sustained period of time, that medium term might be a more persistent headwind than we had anticipated.
That long-lived challenge of the net interest margins.
Exactly. Yes. So
when this ends, do we get back to more Brexit-related uncertainty, or what do we say there?
Well, at least it's pushed it off the front pages. So, no, I think clearly the trade negotiations will or will not be going on in the background. There may be some delays there. And clearly that will still be a very key determinant of what 2021 and beyond looks like. So, I mean, we can't take our eyes off that. But I'm with Dan on the basis that, we were, before the virus, beginning to see, very early signs of much stronger, business confidence, consumer confidence coming back, inquiries, the estate agents, the housing market, and so on. So, ironically, last year when the government was elected, there was a debate about, well, wouldn't it be kind of sensible for the government to have a recession early in its time in office, because then they can be seeing the fruits of investments made now coming through in 4 or 5 years' time ahead of the next election. Bizarrely, of course, through no fault of the government's own, they are now going to have a small downturn early in their term of office. I think the policy response, as we've touched on, was absolutely terrific. I think, far better than actually at the moment. The Fed is still sort of slightly behind the curve. The ECB is calling for governments to give fiscal response, but there is no fiscal unity to do that.
You'd like to see more coordination then between major economies?
Absolutely, and I think we, as Dan said, I felt really proud of our leadership because it was coordinated, joined up. The timely short-term stuff, the structural long-term stuff, and I think we are in good hands in terms of navigating through this, and on a 3 to 5 year view, this doesn't take anything away from my enthusiasm for the UK economy surprising positively on the upside against many people's expectations.
So I'm going to ask a very direct question. Potentially an attractive entry point?
Yes, potentially. Look, who knows? There could be, you could finesse the timing better. We're never going to know. But, is this going to be, are we going to look back on this and say, that was a good time to be putting money to work? Yes.
Richard?
Yes, the Chinese stock market troughed when their virus cases peaked. I think in the inevitable choppy days we are experiencing, there'll be things like, has the Fed got ahead of the curve? Are bond spreads begin to narrow again? And clearly looking at cases peaking and so on. So there will be volatility, but I think given current valuations, both growth and more cyclical stocks, both sound balance sheet and more leverage, there will be extraordinary opportunities that we will look back on, as in so many of these different types of shocks and crises. It's the brave who steps in at this juncture who usually does get the rewards in the end.
Nobody's going to catch the bottom, but you've got to do your best to be as close as possible.
Yeah.
So, sounds as though there's definitely cause for at least some optimism. Richard Buxton, Dan Nickols, thank you very much for joining.